It's another edition of the Trading Tips video newsletter, teaching you how to become a successful trader today. This video newsletter is brought to you by ConsensusPicks.com.
Welcome to this edition of the TradingTips.com video newsletter. In this episode, we'll look at a pair of common reversal patterns, the double bottom and the double top. Without further ado, let's begin. Markets are a marvelous thing. This is a stock chart for Ford from July 1, 1998 to August 15, 1999. Everything you need to know about what happened at the company is encoded in this chart. The question is, can you decipher the code? The preceding chart showed daily candlesticks for Ford's stock price. Our recent video on trendline analysis explained candlesticks in greater detail, but the basic idea is that you get 5 pieces of information about the stock from a single candlestick: its opening price, its closing price, its high, its low, and whether it closed higher or lower than the previous day. When you view these candlesticks in sequence, it can tell a lot about patterns, and it can tell a lot about supply and demand, and that can predict where the stock's going. Add in the 6th element of volume, and the chart really starts to tell the story about supply and demand, the entire basis for all market transactions. We learn to read letters and words as children, but it isn't until we're older that we might have the chance to learn to read the language of economics encoded in charts like this one. To remind you, this is a chart of Ford from July 1, 1998 to August 15, 1999. Let's zoom in on the first 6 months of this chart, ending on January 3, 1999. We'll take a look at an annotated chart on the next slide. If you speak chartese, the language of economics, supply and demand, then this is what the chart would have told you in real time as events developed. First, we notice Ford falling into a downtrend and breaking support. Then it finds new support, and its old support becomes resistance. And the stock price bounces back and forth in this congested area. Where did these support and resistance lines come from? They come from multiple candlestick touches at a particular price level. The logic is that there are buyers at support and sellers at resistance. Whenever stock falls to support, there's a supply of buyers willing to pay that price, and that keeps the stock from falling lower and actually helps move the stock back up until it finds resistance where there are sellers present. They prevent the stock from going any higher and help push it back down. When stocks get really tight between support and resistance, that's called congestion. And the more touches a candlestick has on a particular line, be it support or resistance, the stronger those lines become. And when things get congested, there's lots of touches. So both the support and the resistance line become strong. And the stronger a line of this nature, when it breaks, it really breaks. The break is going to be more significant. When a stock falls below support, as it does here, it's usually going to fall until it finds new support or reaches a new low, as it appears to in this case. Anyway, the stock then rebounds off support and, not surprisingly, returns to its old support line, which has become resistance. It stages a failed breakout because that support line has now become resistance again and then tumbles back to its new lows. These new lows are a little lower than the previous lows, but take a look at that volume. It's falling at trough 2. But then it begins to rise as the stock rebounds out of trough 2. This was a clear indication of a double bottom reversal pattern, and the time to buy would have been October 12. Notice how after the second breakout, the old resistance line becomes support. This gave the stock a base to build on and eventually rocket higher. If you spoke chartese, the language of economics, you could have seen this double bottom and known exactly when to buy. Let's go back to our original chart. Remember, it's from July 1, 1998 to August 15, 1999. You can see that Ford went through a lot of ups and downs over this time. You could have made a lot of money knowing when to buy, when to sell, when to short, and when to cover. And if you could read charts, this is exactly what you could have done. Now, on the previous slide, we were looking at the first 6 months of this chart, which went through the end of December. On the next slide, we'll look at the 6 months starting on December 1. Now here's our chart. In our previous example, we saw a double bottom. Here's a double top. Remember, this is the same stock Ford. It went from a double bottom reversal, and now it's going into a double top reversal. Notice that both peaks in this example actually have multiple touches to create that single peak. That's normal. Double bottoms and double tops are reversal patterns. This means they take place when sentiment is shifting, and that means indecision. That's why we see a lot of testing and multiple touches and that congestion from the earlier chart. Anyway, the important elements of a double top are that the volume is higher on the first peak than the second, and that's true here. And then the volume really starts to pick up as the stock falls out of the second peak. And look at that big spike in volume on May 17. That was a clear indication to short this stock, even for a conservative investor. A more aggressive trader would have already read this chart and made a high probability trade before all this, and it would have racked up even bigger gains. In review, double bottoms and double tops are reversal patterns. A double bottom is a bullish reversal. That means it has to be coming out of a downtrend in order to reverse bullishly. The fact that it's a bottom and a reversal also should make it clear that it's bullish. The opposite is true of a double top. They come out of bullish trends and reverse into bearish ones. Think of support and resistance in terms of buyers and sellers, supply and demand. Rising volume means sentiment is stronger. When you can understand these charting basics, everything else makes a lot more sense. Putting it all together, here's how you could have read this chart if you had known what you were doing in 1998 and 1999. The signs were right there. Double tops and double bottoms, they're not the kind of patterns you have to jump into ahead of time and hope that they'll materialize. You get into these charts after the fact. So knowing what you know now, you could have played this chart exactly as shown here. Congratulations on your future earnings. We hope you've enjoyed this TradingTips.com video newsletter. Thanks for watching and good trading.
This Trading Tips video newsletter has been brought to you by Consensus Picks. Each week, Wealth Buyer's Consensus Picks software scours through 800-plus financial sources to produce a short list of multi-verified stocks. Stocks chosen by more than one of the most accurate stock-picking services. Then the Consensus Pick software automatically analyzes the short list of stocks using a series of proprietary filters. And it picks the single best stock out of the bunch. The Consensus Pick. Sign up today for Consensus Picks, and each week you'll be provided with the ultimate alert, a stock that's been independently selected by multiple stock picking resources. A true Consensus Pick. Visit consensuspicks.com to sign up today. View more Trading Tips videos. Visit tradingtips.com. Sign up for our free video newsletters and become a successful trader today.